So again, to frame my question, what is the precedence do countries like Zambia set for Sri Lanka in terms of debt restructuring?
Sure, I think Zambia is setting all sorts of interesting precedents for how debt restructurings are conducted in this post-COVID environment, especially for countries like Sri Lanka that have a large amount of debt to China. I think it's worth noting that Zambia's restructuring is taking place under the common framework, but as a middle-income country, Sri Lanka is not currently a part of that process. That said, the principles that apply to the restructuring are still likely to be the same. So Zambia, I think, is an interesting comparator for Sri Lanka in the sense that it has a similar debt level, similar debt service burden, similar composition between domestic and external debt. One interesting part of the Zambia restructuring is that the IMF said in their latest report that domestic debt shouldn't be included in the restructuring because it's at about a third of bank sector assets. There would be financial stability concerns from including it. In Sri Lanka, domestic debt is almost identical as a percentage of bank sector assets, almost identical relative to the total debt stock and debt service burden. However, I think that excluding domestic debt in Sri Lanka is likely to be quite a bit more controversial.
What is your favorite book recommendation for our listeners?
So from the sovereign debt perspective, I think a really seminal book in the field was This Time is Different by Carmen Reinhardt and Kenneth Rogoff. They published this back in the early 2010s, and it's basically a historical look at restructurings over the course of the past 8 centuries.
Hello everyone, welcome to Rational Investor. This is your monthly reality check on investment, personal finance management and economy. Today we are going to talk about debt restructuring 101 and the road ahead for Sri Lanka. I'm pleased to have Patrick Curran, senior economist from Tellimer, joining us today to have this discussion. Patrick primarily focuses on emerging market macro and sovereign research across Africa, the Middle East, and Asia. And prior to joining Tellimer, he worked at Eaton Vance in Boston, conducting sovereign fixed income analysis and spent time at the South African Reserve Bank. He holds an MA in International Economics from the Johns Hopkins University in Washington. He's also a CFA charter holder. Patrick, welcome to Rational Investor.
Hi, Pani. Thanks for having me.
So I'm going to begin with an open-ended question. There's this wave of sovereign debt defaults across the globe in recent times. What is the reason behind this phenomena?
Sure. So it's sort of a long-standing problem that's been exacerbated by a series of shocks we've seen since the pandemic. Many emerging and frontier market economies were facing rising debt vulnerabilities in the run-up to the pandemic. The average debt burden for emerging markets, for example, rose from 38% of GDP in 2013, around the time of the taper tantrum, to 55% of GDP in 2019. Due to the need for post-COVID fiscal stimulus, deficits widened by a cumulative 6.7% of GDP amongst emerging markets on average, and this pushed up debt even further to 66% of GDP, so nearly double what it was a decade ago. And then, of course, we entered this year with higher debt burdens and worsening fiscal dynamics, and then we're hit by another series of shocks caused by Russia's invasion of Ukraine, high global inflation, rising commodity prices, and tightening global financial conditions, amongst others. So from a starting point of already a much higher debt burden and worsening dynamics, the starting point for many emerging markets was quite a bit worse. At the same time, rising yields have locked many emerging markets out of the market. So those with large external financing needs, primarily commodity importers, are having trouble financing their balance of payments deficits and are having to turn to alternative financing sources like the IMF and ad hoc support from bilateral partners to plug those gaps. So it's really just been a unique moment of the series of crises all converging at a time where debt vulnerabilities were already on the rise for the past decade or so.
Right. So, Patrick, now I'm going to narrow this discussion down towards Sri Lanka. What is the usual process for debt restructuring for both the external debt and domestic debt?
Sure. So Sri Lanka is already a couple steps into the process. Initially, it starts with their communication of their intention to restructure, which happened back in April. The next step is generally to reach out to the IMF to negotiate a recovery program and define the restructuring envelope and parameters. And once there starts to be some clarity on the reform program in IMF discussions, that materializes into staff level agreement, which Sri Lanka received about a month ago. So at this point, the next step is to begin implementing what in IMF speak they call prior actions, which are basically policy prerequisites that allows the IMF to approve the program at a board level. And to disperse financing, the IMF will also require what they call financing assurances from Sri Lanka's bilateral creditors, which include China, India, and Japan, among others. Only once those financing assurances are received will the board be able to approve the IMF program and begin dispersing financing. And at that point, discussions with private creditors can really start to take off in earnest. And they'll be expected to provide debt relief on comparable terms to what's been hashed out by official creditors earlier in the process. And once there's agreement across all of Sri Lanka's bilateral and commercial creditors on the perimeter and terms of the relief, then that restructuring can be finalized and implemented into the broader reform program. So Sri Lanka is already a couple steps into the process, but still has quite a long way to go.
So I think what you're trying to say is this, anyway, the IMF program is also contingent upon, largely it's been contingent upon receiving financing assurances from the bilateral creditors and also to show good faith to private creditors also.
That's right. And the process, I think, has taken quite some time in other countries. We have ongoing restructurings in Zambia, Ethiopia, and Chad under the Common Framework, among others. And in Zambia's case, for example, it took about 6.5 months between staff level agreement and board approval. Apologies, it took 6.5 months between the staff level agreement and the official creditors finally meeting for the first time, and then another 2.5 months for board approval to be received. So from that perspective, Sri Lanka is still quite early in the process.
Right. Now, anyway, Lazard, they have already begun discussions with the official creditors, and a few weeks ago, Central Bank of Sri Lanka, together with the Finance Ministry, they had a presentations. So, given how Zambia has progressed since they got the staff level agreement, it took them 6.5 months, like you said, to form the official creditor committee meeting. So do you think by at least by mid next year we can finalize these agreements?
Yeah, so I think the government's timeline that they laid out in their investor presentation recently is certainly an ambitious one. So they want to finalize the IMF program by end of the year, and the restructuring itself by mid-2023 at the latest. Like I said, taking Zambia as sort of our precedent here, the process took quite a bit longer than that, right? So if it takes 9 months to get board approval and to get financing assurances, that already puts Sri Lanka into mid-2023. And it's worth noting that I think the restructuring is likely to be quite a bit more complicated in Sri Lanka. There's a much more diverse mix of creditors and types of instruments that need to be dealt with. So from that perspective, it could take even longer. That said, if the recent financing assurances that were provided in Zambia are symbolic of greater urgency from the official sector to move the process forward, then my kind of more pessimistic view could end up actually materializing much more quickly. So really it comes down to how quickly Sri Lanka's official creditors are willing to sit down at the table and form a committee and provide those financing assurances. At this stage, they're really in the driver's seat, and the process will go as quickly or as slowly as they're willing to move it forward.
So in terms of forms of reliefs, what are the typical menu options for debt restructuring for both local and external debt? And maybe this would be a little unfair question to ask, a little premature question to ask. What do you think the most likely scenarios for Sri Lanka would be?
So there's, I think, two key categories when you're looking at menu options for Sri Lanka. The first pertains to restructuring envelope or perimeter, which basically means the debt that will be included or excluded from the restructuring process. So at the very basic level, that comes down to will external or domestic debt be included? When you're looking at the external restructuring, bilateral and commercial external debt will be included. But multilateral debt, which is generally viewed as super senior, will not be. Other options include whether or not SOE debt will be included, whether or not guaranteed versus non-guaranteed debt will be included, if domestic debt is included in the process, whether it will be bonds or just T-bills, and of course in Sri Lanka's case, how will SLDBs be treated? Beyond the perimeter, which already is quite complicated, is the form that the restructuring takes. So there's a number of key options here. The first is nominal haircuts, which are reductions to principal or face value. On the other end of the spectrum, there's what we call cash flow relief, which is either maturity extensions, interest grace periods, coupon cuts, or step up or step down coupon structures. And on top of this, the government may have the option to throw in sweeteners like GDP warrants, for example, which is what we saw in Ukraine's recent restructuring, to help induce creditors to take larger upfront haircuts or cash flow relief. Different creditors will have different preferences. Some, like China, for example, prefer not to take any upfront nominal haircuts. And to instead offer their relief via cash flow relief. Other creditors may be more willing to provide nominal haircuts in exchange for a more normal, so to speak, coupon structure. But ultimately, the key point is that across these options, relief needs to be equal in present value terms across all available options. And there may very well be a menu of different options that creditors can choose from as long as it satisfies that equal treatment requirement.
So, in your opinion, what precedents has Zambia set for countries like Sri Lanka? Now, the IMF granted the board level approval for Zambia for a 1.3 billion extended credit facility in early September, together with an 8 billion cash flow reliefs. And they published a DSA, a debt sustainability analysis, that serves as the basis for restructuring. And as per the DSA, 35 to 45% principal haircuts are being looked at. So again, to frame my question, what is the precedence do countries like Zambia set for Sri Lanka in terms of debt restructuring?
Sure, I think Zambia is setting all sorts of interesting precedents for how debt restructurings are conducted in this post-COVID environment, especially for countries like Sri Lanka that have a large amount of debt to China. I think it's worth noting that Zambia's restructuring is taking place under the common framework, but as a middle-income country, Sri Lanka is not currently a part of that process. That said, the principles that apply to the restructuring are still likely to be the same. So Zambia, I think, is an interesting comparator for Sri Lanka in the sense that it has a similar debt level, similar debt service burden, similar composition between domestic and external debt. One interesting part of the Zambia restructuring is that the IMF said in their latest report that domestic debt shouldn't be included in the restructuring because it's about a third of bank sector assets. There would be financial stability concerns from including it. In Sri Lanka, domestic debt is almost identical as a percentage of bank sector assets, almost identical relative to the total debt stock and debt service burden. However, I think that excluding domestic debt in Sri Lanka is likely to be quite a bit more controversial. One reason for this is that in Zambia, external creditors hold about $3.25 billion, or over a quarter of the domestic debt stock. So they're unlikely to push back against the government and IMF's plans to exclude it from the restructuring. Whereas in Sri Lanka, the amount of non-resident holdings of domestic debt is negligible. And excluding domestic debt from the process means a heavier relief effort will be required from Sri Lanka's external creditors to meet those same debt sustainability thresholds. So this is just one of, I think, the few aspects that are likely to be controversial in Sri Lanka and potentially differ from the restructuring in Zambia.
Right. So domestic debt restructuring, we'll come to that a little bit later because I have a whole lot of questions on that. But before going to that, I'm going to come to the next question: equal treatment in debt restructuring. Now, this is a topic that has been widely discussed among policy circles here since lately. So I'm trying to understand what is equal treatment, and practically, are all debt treated equally?
Sure. Equal treatment is really the cornerstone principle of any external debt restructuring. At its most basic, all bilateral and commercial creditors involved in the restructuring must provide equal treatment in present value terms. Now, in practice, this is really difficult to calculate because present value relief depends on the discount rate that you choose, which is a topic we can explore later if you'd like. But the general principle is that relief from one set of creditors should not be used to pay for less generous relief provided by another set of creditors, basically creating a free rider problem.
Right. So now I'm going to come to ISBs and equal treatment. Now, the total ISBs, the international sovereign bond stock, is about US $12 billion, of which nearly 30% is held by the local banking sector. Now, given the banking sector's exposure, the sizable exposure to the ISB, and the likely challenges on the financial system stability, what would be the ideal scenario when it comes to ISB? Discrimination among identical instruments, or equal treatment among identical instruments, but then followed by additional compensation in the likes of banking sector recapitalization? What are your thoughts on this?
In my view, there's absolutely no space for differing treatment within instruments, especially as it pertains to Sri Lanka's Eurobonds. Now, of course, there's a risk that restructuring of Sri Lanka's Eurobonds causes some financial stability problems for Sri Lanka's banking sector, but ultimately the spillover effects will need to be assessed in advance via stress tests on domestic banks and then managed after the fact via regulatory forbearance and, if needed, recapitalization. But there's really absolutely no room within the context of the current restructuring framework for differing treatment across holders of the same debt instruments.
Okay. Now, talking about SLDBs, now you briefly touched on this again, equal treatment principle and SLDBs. The authorities continue to rule out the possibility of restructuring Sri Lanka development bonds, SLDBs. Now, these are instruments that are denominated in foreign currency, issued under the domestic law, and held by residents. And what we hear is some of the maturing SLDBs, the government has already settled the creditors in local currency. And regulatory forbearances has been given in terms of managing the net open position when it comes to SLDB assets. Again, what is the possibility of SLDB getting restructured in the light of equal treatment principle?
I think exclusion of SLDBs is also going to be a non-starter for private bondholders. And the reason for that is that for every instrument or class of creditor that's excluded, there's more relief required from the creditors that do participate in the restructuring. So excluding super senior multilateral debt from the restructuring, only about 75% of Sri Lanka's external debt stock is restructurable, so to speak. Excluding SLDBs, which are about 3.5% of GDP and held almost entirely by residents, then the restructurable external debt stock falls even further to only about 2/3 of the total, which will require an even heavier lift from bilateral and private external creditors. So I think seeing as their foreign currency denominated instruments, regardless of the law under which they were issued, I think private bondholders will really push hard for their inclusion in the restructuring. I think I appreciate the point that there's already some relief being offered by settling obligations in rupee or extending maturities. But ultimately, this in present value terms is going to be quite a bit smaller than the relief that's being offered by Sri Lanka's other external creditors. And I think they're going to push hard for the principle of equal treatment to apply to the SLDBs as well.
Now let's talk about the elephant in the room, the possibility of a local debt restructuring happening here in Sri Lanka. Now, many economists have put forward the assumption that only the central bank balance sheet will get restructured. What are your views on this? And restructuring only the central bank balance sheet, is this enough to move the needle?
I think this is going to be a really central question in Sri Lanka's debt restructuring. So zooming out a bit and taking a historical perspective, since 1980, domestic debt has been directly restructured in only about 30% of all sovereign debt restructurings. But there's been about another third of restructurings that have taken place by the back door, so to speak, via financial repression and inflation. And that's what we're seeing in Sri Lanka, right? I mean, with inflation running at 70% and a 45% currency devaluation year to date, domestic bondholders will argue that they've already experienced a pretty large upfront haircut. Just looking at the impact of the devaluation and inflation, local currency debt has fallen from about 61% of GDP at the end of last year to 52% in mid-2022. So it's fallen from about 53 to 43% of the total. Which means that there's less of a strong argument than there was last year for domestic debt being included in the process. That said, Sri Lanka's debt burden is incredibly high, and excluding domestic debt from the process is going to make it really difficult to restore debt sustainability. As I mentioned earlier, Zambia's restructuring sets an interesting precedent in that the IMF has determined the financial stability risks to including debt in the restructuring to outweigh the potential benefits. In Sri Lanka, which has a similar portion of banking sector assets comprised of government debt and has a similar debt stock and composition than Zambia, presumably that argument would hold as well. We've calculated that due to limited excess capital at Sri Lanka's 5 largest banks, recapitalization would likely be needed once domestic debt haircuts exceed around 5% without any regulatory forbearance, or about 14% with regulatory forbearance. And if the government has to step in to recapitalize banks, then the fiscal costs of doing so could offset the savings from the debt restructuring. That said, domestic debt absorbs well over 3/4 of Sri Lanka's interest burden, which is unsustainably high. And as I said, excluding it from the restructuring is going to make it even more difficult to hit those debt sustainability thresholds. So I think Sri Lanka's bondholders will argue forcefully for their inclusion in the restructuring.
So I'm going to backtrack. So what you're saying is restructuring only the central bank balance sheet is not enough in terms of achieving the DSA targets that will be set forward by the IMF.
It would certainly help on the margin, but I mean, at the end of the day, the central bank holds only about 20% of domestic government securities. So restructuring just the central bank debt would have a noticeable but still quite small impact on the overall debt stock. And including central bank securities could still negatively affect this income, capital, and pool of marketable instruments to conduct open market operations. And could in the extreme require capitalization. So I think that just looking at the central bank debt doesn't necessarily forgo the problems of including domestic debt in a more holistic way, and just kind of limits the pool of restructurable securities and the ultimate impact of that domestic restructuring.
Okay. Now, if there is a local currency sovereign debt restructure, will the debt holders be treated equally, or will the incidence of DDR, domestic debt restructure, will it be disproportionately shared among the creditors? I'm asking this question because most of the local sovereign debt is held by the local banking sector and also the government pension fund, employee provident fund. Also, what inferences can we draw from countries that have gone through a DDR, that of Suriname, that of Barbados?
Yeah, there's much more leeway on the principle of equal treatment when it comes to domestic debt restructurings, which are ultimately determined under domestic law. Treasury bills are often excluded from the process. That said, they're not always excluded. If the financial stability considerations warrant a more lenient treatment for certain types of domestic creditors, and or if the cost of fiscal support or recapitalization outweighs the benefits of including certain creditors, then there could well be differing treatment across different types of domestic creditors. Just looking at the historical examples, Jamaica did a domestic debt restructuring in 2010 and 13, which involved coupon cuts and maturity extensions that led to NPV relief of around 10 to 20%. And T-bills were excluded from the restructuring in the case of Jamaica. Barbados more recently in 2018 restructured both domestic and external debt, and included T-bills in the restructuring because they were a very large portion of the domestic debt stock. And Suriname, similar to Jamaica, excluded treasury bills. So there's a bit more leeway on the equal treatment principle when it comes to a domestic debt restructuring, and really comes down to balancing the financial stability risks and recapitalization costs with the potential benefits of including differing classes of creditor.
Right. Now that you have touched on treasury bills, I'm going to touch on that. Now, I think Sri Lanka's total debt stock, both bills and bonds, comes to about 12 trillion, and of which treasury bills about 3.8 trillion. So that comes to about 30% of the entire debt stock. So 30% treasury bills holding, do you think treasury bills getting restructured? Is it a possibility? And why I'm asking this particularly is there's a notion among local investors that T-bills will not get restructured. And as a result, we've seen most of the recent auctions, it was the short end of the yield curve that got oversubscribed repeatedly. So what is the possibility of Sri Lanka seeing T-bills getting restructured, given that it's only 30% of the local debt stock?
Yeah, it's a good question. I think it's a bit too early to speculate at this point, but just by way of example, in Barbados, which is a case where they were included, T-bills were about 40% of the stock, so a bit higher than in Sri Lanka, but not completely out of the ballpark. While T-bills are less than a third of the domestic debt stock, the interest rate on those instruments are quite high, around 30%. So they're a pretty high portion of the debt service bill. If Sri Lanka is able to roll those over at lower rates, clearly with short maturities, they'll be able to roll them moving forward. And hopefully the rates will be lower than the 30% we're seeing now, then maybe there's no need to include them in the restructuring. And I think the government and the IMF will both strive to exclude them to the extent possible. But it really comes down to the debt sustainability analysis, and if that says that that sustainability can't be restored if T-bills aren't included in the restructuring, then they may have to be looped into the process as well.
Now, when it comes to SOE debt and government guaranteed debt, are these usually included in a DDR exercise? Again, what lessons can we learn from countries that have gone down a similar road?
So the government has already said that guaranteed SOE debt will be included in the restructuring. It's still not clear at this stage if non-guaranteed debt will need to be included. But generally, SOE debt is not restructured if they're solvent on a standalone basis. But if they require government support, then there's a strong argument for including them, as otherwise the government will be left having to make transfers to service the debt stock. And this is the case for many of Sri Lanka's SOEs. And of course, one interesting test case is the treatment of Sri Lanka Airlines, which in the past has required extensive government support, but where the debt has so far not been included in the restructuring. This could be a point of contention unless the company can show that debt is serviceable on a standalone basis without government support.
So my next question is, assuming that there would be a domestic sovereign debt restructure, where would you find greater NPV losses? Will it be in the short end of the yield curve, or will it be in the long end of the yield curve?
I think the key difference will come down to T-bills and bonds. As we discussed earlier, there's a chance that if domestic debt is restructured, T-bills are excluded from the process. But looking across the maturity curve for bonds, I think it's speculative to try to determine which ones are going to experience more or less of an NPV burden. I think it's just too early in the process to tell.
Okay, understand. So my next question is about exit yield. What is an exit yield, and how does it differ from discount rate?
So the exit yield is the yield that the newly issued bonds will initially trade at after the restructuring. For private creditors, this will determine the initial hit that they take in present value terms. On publicly traded bonds, this yield will fluctuate daily after the restructuring based on country-specific and external risk factors. But generally, yields are likely to fall if reform implementation is good and the restructuring restores sustainability, or otherwise to rise if the restructuring is not viewed as credible, which is what we saw in Ecuador and Argentina's restructurings in 2020. Relatedly, the exit yield is the discount rate that's used to calculate the present value of relief offered by each group of creditors, and determines whether there's comparability of treatment across participating creditors.
So, in your opinion, what kind of exit yields do you anticipate for Lk Eurobonds?
In normal times, we would use a range of around 8 to 12% when we're modeling recovery values, depending on the credibility of the restructuring and reforms. But these are very far from normal times for emerging market debt. The yield on the high yield emerging market sovereign debt index has risen above 12% from a post-COVID low of 6% just about a year ago, and a 2010 to 19 average of 7.5%. So even for performing credits that aren't in crisis right now, yields are already pushing double digits. So because of that, we've revised our exit yield range to 10 to 14%, with a 12% midpoint rather than 10% as we would have used in years past.
Okay. So should there be a single exit yield used for all creditors, or should there be multiple ones that should be used depending on the risk environment in which each creditor is operating?
This is a really contentious and important issue in debt restructurings. So when the IMF calculates this debt relief for creditors, it uses a somewhat arbitrary 5% discount rate in its DSA. And as I said before, market yields have now risen well into the double digits. So a 5% discount rate is increasingly out of line with the rate that's faced by private creditors in the open market. So from this perspective, multiple exit yields, for instance, one for concessional debt, one for non-concessional bilateral debt, and one for commercial debt, may help to reflect the different risk and reward environments in which each type of creditor operates. On the other end of the coin, though, this might result in a perception that private creditors are providing less relief due to the use of a higher discount rate. So this is likely to be a key point of dispute in the restructurings that are ongoing now, including Sri Lanka and Zambia. To resolve this over the longer term, I think it would be helpful to specify discount rates in advance that will be used to calculate the present value of debt relief, and to settle on a concrete and simple framework for how that present value of relief will be calculated. But barring a framework at this stage, I think is really going to have to be hashed out at the negotiation table. And if bondholders have their relief calculated in present value terms at a 5% discount rate, they're going to face much larger losses in present value terms based on a more appropriate market rate. And I think this is going to be a big issue for them in the restructuring.
Correct. So you did a report a few days ago on 5th of October. You issued a buy rating on Lk Eurobonds, given that the prices have plummeted to 25 cents on the dollar. I would like to know your thesis, your prognosis on Lk Eurobonds, and perhaps what kind of recovery values you're expecting and what kind of scenarios are you looking at?
Sure. We did a recovery analysis back in March where we put a recovery value of 25 to 40 cents on the dollar at 12 to 14% exit yields for Sri Lankan Eurobonds. Now, as I mentioned before, I think the process is likely to be a really long and difficult one for all the reasons we've articulated over the course of our discussion. But with bond prices dropping to 25 cents on the dollar this week, I think they're now attractive from a valuation perspective with some potential upside. So we did a quick back of the envelope calculation where we figured out where Sri Lanka's bonds would break even at current prices. And that would, in our really bearish scenario, we did a 50% coupon cut, 50% nominal haircut, and 5-year maturity extension. And in this scenario, Sri Lankan Eurobonds would break even at a 16% exit yield, which, as I said earlier, is really quite high, even in the current high interest rate environment. So from that perspective, despite the fact that the restructuring is likely to be really long and difficult, I think that bonds are now trading towards the lower end, if not below recovery value, and are now attractive purely from a valuation perspective.
Okay. So my next question would be, I'm trying to understand globally, how have the banking systems got affected from a DDR and an EDR?
So in recent public debt restructurings, the financial stability implications were assessed in advance using stress tests across banks and other non-bank financial institutions. And to the extent that there were negative spillover effects, these can be managed through a combination of regulatory and crisis management measures, which have included, for example, setting up a financial stability fund to provide solvency or liquidity support, or in the extreme, direct recapitalization of banks by the public sector. Now, bank recapitalization was only carried out in those cases where banks experienced significant capital shortfalls. But in some cases, banks were able to absorb those losses, which include Barbados, Grenada, St. Kitts and Nevis, and Jamaica. So it's not certain that if there's a domestic debt restructuring, there will have to be a bank restructuring or recapitalization. But really, the risk of that needs to be assessed in advance using stress tests. and then the costs and benefits of including that debt can be calculated in a more concrete way.
Okay. Have you done an analysis on the Sri Lankan banking sector and the possible impact from both EDR and DDR?
Yeah, as I said earlier, there's very limited capacity for Sri Lankan banks to absorb losses currently. We calculated that with 5% nominal haircuts on domestic debt, Sri Lankan banks would require recapitalization without regulatory forbearance. That rises to about 15% if there's some regulatory forbearance measures put into place. But still, that points to very limited loss absorption capacity. And that means that if domestic debt is restructured, then bank shareholders will likely have to be bailed in. I think external creditors will stop short of demanding that depositors are bailed into the process. But I think there will have to be some losses shared amongst bank equity holders and potentially creditors, just due to the very limited buffers. And by requiring the public sector to recapitalize banks, the benefits of including them in the restructuring can be washed away pretty quickly. So I think there's going to need to be losses absorbed from the banks themselves.
Okay. So my next question, it's an unfair question, but I think it's still necessary to ask that. Let's assume hypothetically, one of the bilateral creditors, they disagree to reach a consensus with the rest of the creditors. Is that a possible scenario? And in such a scenario, what are the options we are looking at?
So none of the three major creditor groups, be it the Paris Club bilateral creditors, non-Paris Club bilaterals, or commercial external creditors, want to agree to a restructuring deal until they know for certain that the others will accept comparable terms. If any creditor is reluctant to negotiate or doesn't disclose the terms of his debt relief, then the entire process essentially grinds to a halt. Now, in the past, most external debt was extended by Paris Club bilateral creditors. But now with the rise of Eurobond issuance and other external creditors like China, for example, that's no longer the case, which is part of the reason we're seeing much more complicated restructurings currently. In Sri Lanka's case, this is particularly an issue. 60% of its bilateral debt stock is owed to non-Paris Club members, mostly China, which is about 50%, and India, which is another 12%. And Japan is the other major bilateral creditor. Now, we've seen delays in the recent common framework restructurings in Zambia and Ethiopia due to the reluctance of China to participate and sit at the negotiation table. So in this context, initial statements of disapproval by various Chinese officials in Sri Lanka's decision to default, I think, are quite worrying, because ultimately the process can't move forward until all creditors, especially China as the largest one, is willing to sit down at the table and negotiate.
My next question is, how long does it take for a country's sovereign rating to get upgraded post a debt restructuring? Because right now what we are seeing is since the country's sovereign rating, it's in the default status, the banking sector is finding extremely difficult, and a lot of corporates, they are paying extremely high premiums on LCs.
So the upgrade tends to happen basically immediately after the restructuring is finalized. So the credit ratings typically will be upgraded once the process is complete from default or selective default to somewhere in the single B range. That said, it'll take some time for ratings to go back to pre-crisis levels, potentially a few years if the restructuring goes well. But we should at least see a pretty immediate upgrade into that single B range once the restructuring is completed.
So usually for it to go back to pre-restructuring level sovereign rating, how long does it take? I mean, hypothetically, T+3, T+4 years?
Yeah, I mean, I think it depends on how successful the reform program is. I think if Sri Lanka hits all its targets under the IMF program and the restructuring is successful in restoring debt sustainability, it could be, 2-3 years. And in Sri Lanka's case, even before the crisis, they were already trading in the single B range. So they'll be upgraded probably pretty quickly to that pre-crisis level on the basis of that level already being so low in the first place.
Okay. And how long would it take for the sovereign to regain market access again post restructuring?
Yeah, one of the key arguments against sovereign default is that it locks countries out of the market for many years. But in practice, we find that sovereigns typically regain market access within about 2 to 3 years after a public debt restructuring. However, there could be a default premium associated with that. So basically, that means they'll have to issue at rates higher than what they could have issued at before the default. The literature on this is mixed, though. Some studies have showed that it's a very small and short-lived premium, while other studies have showed that countries have to pay quite a bit more to issue debt after the restructuring. But effectively, they should be able to regain market access by the end of the IMF program, which is about 4 years, and if not sooner.
Right. So on average, what kind of default premiums are we looking at? At least from the recent experiences, what have you seen?
Yeah, I mean, like I said, this is really a controversial topic in the literature. I think some people say there's no premium at all. One recent IMF study, 2015, so not that recent, but that showed a 400 basis point premium immediately post-default and 200 basis points after 5 years. So that suggests that the premium could be quite large. Obviously, that's a wide range from 0 to 400, but ultimately there's likely to be a bit of a premium. It's likely to last a few years. But if Sri Lanka wants to re-enter the market within 2-3 years and they're successful in their reform program, then they should be able to do so.
Okay. So an extension to that question in terms of market access, hypothetically, if there's a domestic debt restructuring, how will it impact central banks' ability to raise money from the domestic market? And what has been the global experience?
Yeah, I mean, I think the resumption of domestic market access is basically immediate when you compare it to external, and that's because it's a much more captive investor base. That said, the real long-term domestic bond yields tended to rise sharply around restructurings, and it took several years to revert towards their pre-crisis levels. So while Sri Lanka is likely to be able to continue issuing in the domestic market after the restructuring, it's likely going to be at higher real yields for quite some time.
Okay. Now, as per the IMF DSA they've done for Sri Lanka, they are looking at about a primary balance of 2.3% by 2025, a plus 2.3% from a projection of a negative 4% in 2022. Do you find this too very optimistic? What's your view on this?
An adjustment of this magnitude is definitely very ambitious. It would be in the top decile of all IMF-supported programs for low-income countries since 1990. So again, it's very ambitious. And from the Sri Lanka perspective, the max primary surplus they've been able to attain since 1990 was a positive 0.6% of GDP, which occurred back in 2018 before the tax cuts. And the average balance in the decade pre-COVID was a 1% deficit. So, no matter what metric you're looking at, is a 6.3% of GDP adjustment over the course of 3 years and a 2% primary surplus really is quite an aggressive adjustment. That said, there's lots of low-hanging fruit in Sri Lanka. Revenue was 13.5% to 14% of GDP in the 3 years leading up to the 2019 tax cuts. And this compares to just 8.3% of GDP last year and an 8.8% target in 2022. So there's clearly lots of room to boost revenue. The 2019 tax cuts, according to the president, cost an estimated 3.5% of GDP. Government has already reversed many of these tax cuts. That said, to get revenue back to the pre-tax cut levels, they're likely going to have to go even further with other new revenue measures because of erosion of the tax base in the years since. There's also some low-hanging fruit on the expenditure side. CapEx was about 4.5% of GDP over the past 2 years. That can be reduced at the margins. And subsidies have also been rather costly at about 4% of GDP over the past 2 years. So it's definitely going to be a difficult adjustment. But at the same time, I think there's lots of low-hanging fruit in the form of new revenue and cutting fat on the expenditure front for Sri Lanka to achieve those targets.
Okay. So with that, we are almost coming to the end of segment 1 discussion. So before we conclude the segment 1 discussion, my last question is, if all goes well, do you expect a significant increase in foreign portfolio inflows to Sri Lanka post debt restructuring?
So I can't speak to equity flows, but I can speak to the fixed income side of things. And I think it's going to take some time, right? I mean, real yields will have to go into significantly positive territory, which, we're quite negative right now. Before the restructuring, I think it's worth mentioning, there was really no participation in the Sri Lanka domestic debt market by non-residents. And we've actually seen an uptick in portfolio inflows over the past couple of weeks to about 60 million, which I think is reflective of foreign investors speculating on the exclusion of domestic debt from the restructuring. But of course, it also depends on external conditions. Portfolio inflows are unlikely in the current environment of a strong dollar and tightening global financial conditions. So there needs to be a number of things that go right, both on the domestic and external front, before fixed income investors start looking at Sri Lanka as an attractive investment destination again.
Right. So with that, we are coming to the end of part 1 discussion, the topic discussion, and now we are coming to part 2, the light-hearted question segment. So my first question in segment 2 is, Patrick, what is your favorite book recommendation for our listeners?
So from the sovereign debt perspective, I think a really seminal book in the field was This Time is Different by Carmen Reinhardt and Kenneth Rogoff. They published this back in the early 2010s, and it's basically a historical look at restructurings over the course of the past 8 centuries, and I think is really useful in drawing lessons on how restructurings have taken place in the past, how often they've occurred, and shows that, despite the fact that we view these as really tail risk events, they've actually occurred quite regularly over the centuries.
So who recommended you this book, and when did you read this book?
I first read it back in university. I think it's a text that's recommended in a lot of economics classes, and have, habitually brushed up on it and looked at the data over the years. Like I said, I think it's easy to kind of get tunnel vision and just look at recent restructuring examples when you're trying to suss out potential recovery values and likelihood of default. But I think it's just a nice reality check to look back and take a much more long historical view of the issue. Okay.
So I'm pretty sure in your profession you must be doing a lot of reading. So what helpful habits or techniques have you developed over the years in terms of greater comprehension?
I've really recently gotten into audiobooks. I think is a great way to multitask. Obviously it's been a pretty busy year with all the debt crises going on, and all the market turmoil. So I really like to download my texts in PDF form and listen to them on a text to PDF converter, or listen to books in audiobook format so I can multitask and listen to them while I'm working out, cooking, doing dishes. It's a great way to make a more efficient use of my time and to stay sane with all the reading that we have to go through.
So on that note, what is your current read?
I'm just started reading The Inheritors by Eve Fairbanks, which is a book about race relations in South Africa. It's an issue that's near and dear to my heart as someone who lived in Johannesburg for a short period of time, and I think is a really interesting topic, and she provides some great perspectives.
Okay, interesting. Right, so the second question is who's your favorite person to invite for a dinner party from the industry? In other words, whom do you look up to in the industry?
I acknowledge that a dinner party centered around a discussion of sovereign debt restructuring probably isn't the most exciting party to attend. But if I was hosting that party, I'd probably invite Lee Buckheit, who's really been one of the most important people in the field of sovereign debt restructuring over the years. I think he's worked on several dozen sovereign debt restructurings over the past 4 decades. Many of the most important ones in recent years. I'm an economist, I'm not a lawyer, so it's a constant struggle for me to try to wrap my head around all these constantly changing and evolving legal concepts in the field of sovereign debt restructuring. And he's really the godfather of the field, so I think would be a great person to sit down with and pick his brain. And I'm sure he has a lot of interesting stories and anecdotes over the years.
Oh, I'm pretty sure about that. Recent disciple of Lee Buckheit, and I really love his tongue of the cheek style of writing. You don't feel like you're reading an academic paper.
Exactly. I think he does a good job spicing up what might otherwise be a boring topic for a lot of people.
Fantastic. I mean, I hope you'd invite me for this party, because that would be like a total fangirl moment for me also.
Of course, you'll be the second person to get an invitation, I promise.
So on that note, let me ask, are you a good cook?
I am. I do really like to cook, almost as much as I like to eat. But yeah, I try to cook as much as I can.
Okay, so let me ask this question in a different way. So if you were a host in a party, and if you're going to have Lee Buckheit, what is the dish you're going to make? What is the best dish you can do?
Ooh, good question. So I went to grad school in Bologna, Italy. So eggplant Parmesan is a dish that's very near and dear to my heart, and one that I like to make for parties. So I think I'd probably give that a go.
Okay, eggplant Parmesan. Okay. Now, let me get the picture right. We're talking about a perfectly fried eggplant, wedded with stretchy mozzarella, and that with generous amount of Parmesan cheese, and all that richness and goodness baked in a delightful tomato sauce. Is that what we are talking about?
That's exactly it. You might be overselling my abilities a bit, Pani, but that's what I'm aiming for.
Okay. So tell me, do you make your own tomato sauce?
Yeah, I usually do. I usually get a can of tomatoes and make the sauce just really simply with garlic and basil and olive oil.
Okay, look at you speaking like a true Italian who puts his heart and soul into
I try.
it. Yeah, well done. What did you say? Ben fatato. Did I
Buon
pronounce it?
appetito.
No, I looked up this Ben fatato. I think it says well done. Anyway.
Okay, I don't know that one. I'm
So-
learning something new on this call too.
Yeah. Okay. So final question. Now this picture wouldn't be perfect. Wouldn't be complete without good wine. Eggplant, Parmesan, and wine. So what should I pair this with? Red or white wine?
Oh, I couldn't agree more, Pani. I think a good Sangiovese is probably a safe pair with the tomato-based dish like eggplant parm. So maybe Vino Nobile or Chianti or something like that.
Okay, I'll take your word for it. So with that, the episode number 3 is coming to an end. And Patrick, thank you so much for joining. I absolutely love talking to you, and thank you so much for sharing your knowledge and your opinions and your views. I hope to talk to you soon again in another episode. And dear listeners, thank you for joining us. We'll see you soon with another episode. And before concluding this, Patrick, any final remarks from you?
No, I mean, I think we've covered a lot of ground, Pani. It was great to be here. Great as always to chat with you. And I look forward to continuing the discussion over some nice red wine at our sovereign debt dinner party.
Definitely. I definitely look forward to that, having chats with Lieberkai and enjoying your eggplant parmesan over nice wine.
Beautiful.
Okay, so again, everyone, thank you for joining. We'll talk to you soon in another episode.